Joining me this weekend is Blake Morrow, the Pipsar. Thanks, Blake, for joining us. Pax is joining as well from Chicago, and a new member of the team for this week, at least, Samantha LaDuc, who joined me a couple weeks ago in the afternoon, and she's joining us from north of Boston, where apparently there's no more beer. It seems like beer has run out in Boston because of the World Cup action. Well, last week was interesting. Big moves from the bond market, the dollar. We have a new Fed chair. That was kind of the big deal. It was also expiry week, which I think helped hold us together. We talk a lot about the flows every morning and every week as well. And so now a bunch of the supportive flows, the gamma positioning is kind of off the board. The window of potential weakness, as Jem Carson likes to call it, has reopened. And so cross asset signals, I think, are going to be a little bit more important this week. We had a big move in the dollar, as I mentioned, big move higher in yields. Half of the Fed's committee now is looking for a rate hike this year. 6 of the 18 members are looking for 2 or more rate hikes this year. 35% chance of a rate hike as early as the next meeting in July. So a lot to discuss. The elimination of forward guidance as well from the Fed chair. So the Fed's moving things, and we'll see if the equity market actually reacts. But I want to just start over with you, Blake, since FX was kind of the big mover and the dollar last week really started to shake the tree a bit. I'm curious how you're thinking about the setup for this week in the dollar and how it might impact everything.
Well, first of all, I want to just say, happy Father's Day to all the dads out there. Keep up the good work out there, gents. As far as the dollar goes, I'm really staring at the dollar index as a whole. You can see. Oh, here, I'm sorry, I was just looking at something else. So let me grab the dollar index for you guys. The dollar index is actually in a bull flag formation, and so overall it looks pretty bullish. And we are approaching a long-term 38% retracement, but most important thing about the dollar index right now is it is in breakout territory and it hasn't pulled back. There's a couple pairs that really have my attention. One of them is the Aussie. The Aussie is holding above 70 cents. It's a big figure number. It's also triangle support, but it's in a head and shoulder pattern. So it does look like it's going to eventually break down, but it's not going to do that without risk aversion, if you will. And so the market's still holding up really well. Obviously, the S&P futures right now are at 75.47. 25 bid, and so they're holding up overall. So that means the dollars shouldn't get too far away from us. But with this breakout in the dollar, we get much above like 101.30. You can see it's in teal here. It's also the 38% retracement. That should kind of unleash a little bit of dollar strength. And overall, when the dollar, you look at the dollar, and a lot of people like to look at the dollar and say, well, maybe it's U.S. exceptionalism. In this case, it might be a little bit of that, but I think this is more of a liquidity issue and a rates issue. So, as the dollar firms up, don't look at it as it's necessarily a good thing. It isn't always a good thing. If the dollar is strengthening in this environment when we're up at our highs, that means that it might put some downside pressure on risk. And as you pointed out, Craig, the market was held up by a few things, I think, last week, but now that we've gotten past, the options expiry, we've got a new Fed chair who's undoubtedly a little bit more hawkish than the market was expecting, hence the market reactions across the board, especially in the short end of the curve. I just think that the dollar looks at risk of continuation here. And if it does, that might not be necessarily a positive thing for risk appetite as a whole.
Yeah, no, that makes sense. But Pax, I'm curious, as you think of the setup into this week, for equities, we haven't talked a lot about the dollar as something that has been on your radar screen as a driver here. Do you suspect that you'll be looking at it more, or not necessarily, part of the playbook at this point yet?
No, I always look at it, and I called Blake on Friday when I was going after the close, when I was going to work out, just to kind of chat about the week and see what he said. And we talked a lot about the dollar, and I'm very interested in getting Samantha's thoughts on it too, as we were talking about before the show. But from a trading standpoint, I don't trade the dollar. It's not something I've ever learned to do, much to my detriment. I've learned how to trade the S&P against the bonds. I've learned how to trade the S&P and the NASDAQ against gold. but never against the dollar. So it's always best for me to keep things simple and focused on my process so that I don't start to overthink things and start to take, some macro-based trades, that I'm not going to fully understand all of the factors going into it. Now, when I do find myself positioned one way or the other, then I'm going to pay attention to the macro at that point. What's going on with the dollar? I'm short S&P, the dollar's spiking, gold's getting whacked. Bonds are selling off. Do I want to add, or do I want to my position, or do I want to turn around and flatten and take the money? When something like that is going, I'm more likely to add, but I'm not going to take a trade as a result of it, if that makes any sense, Craig. I need to keep things I'm Irish. I have to keep things simple. My Uncle Artie used to say that all the time. I'm Irish. Repeat it back to me. So, I keep it simple.
Yeah, no, it makes sense. Samantha, I think you say this, the dollar makes the weather, maybe. I forget. I think that's one of your coins, but I'm curious, how are you thinking about the dollar for this week and the implications for equities? I want to kind of transition into your outlook here for the equity market as we head into, I guess this is the second to last week of June.
Yes. So I do have a saying, the dollar makes the weather, and its rate of change determines its severity. So right now we have been in a sideways consolidation pattern for many, 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 many months, right? It stayed firm. It hasn't, taken off or fallen, which was, kind of a baseline for a lot of precious metal bulls. And then when I was on the show with you a week and a half ago, I said, I am dollar bullish. I'm also expecting USD JPY to get above that 161. And that combo factor is going to be bearish for gold. Also, if they do a yen intervention, and they've spent an enormous amount, 11, 12 trillion Japanese yen in intervening in the bond market in Japan to kind of lift a little bit of this political instrument that we know of called the yen. Didn't work at all. But while they have been doing this yen intervention, gold in particular and precious metals in general have been falling very strongly in April and in May. So here we are, new Fed chair, and the literal warning of my client post was in capital letters, watch the dollar, because it wasn't just that we were going to have potential for a hot print, meaning, hikes, pulled forward in the future from the committee, but also they have, as you saw, it was a hawkish hold, right? 9 of the 18 FOMC members expect a rate hike. You've already given chances for July, definitely end of year, but also the PC expectations were very hot. So, they came in almost a full percentage point since March higher. So and slightly lower GDP growth for 2026. So that dollar spike that we got post FOMC meeting was kind of a risk off warning. And I think it is starting. And also the dollar yen at the 161, really pivotal. That's when they have come in 2 years ago did the intervention also when we had that market unwind in July of 2024. So I think that this is a potential that is coming in to a theater near you where we have yen intervention, but it's having diminishing rate of return. We have Warsh coming in, seemingly hawkish, but I think he has a little other plan, which is to get negative real rates negative and stay negative, which is kind of stealth QE support. So I think we have to have this tussle going on between the macro and the currency market, which absolutely the dollar makes the weather. And now its rate of change, its speed at which it can run will impact everything else. So it can quickly turn to be a headwind for equities, especially when you combine it with rebalancing into the end of the month. But ultimately, I think we're going to have to wait with rebalancing into the end of the month. But ultimately, I think we're going to have to wait for the next shoe to drop in the energy crisis, which is the Iran war, for us to really have Fed rate hikes on the table.
Yeah. Samantha,
Pax,
can you
go ahead, Pax.
real quick? What did we were talking about it earlier too about Warsh. Warsh is going to force kind of a QE on us with negative real yields, right?
Mm-hmm, mm-hmm.
Yeah, that's so smart and such a great observation.
That's mine. He's removed forward guidance, right? No transparency. He's moved the goalposts on inflation, threatened to. He's also bringing in outsiders, and some might think that's good. But if they're Project 2025 focused, it might be also why the dollar is spiking on reduced Fed independence. He'll get some committees in place. And he's, by the way, the breaker of the vote. In other words, if they have a tie, he gets to break, he gets to choose. So there's a lot that's going on with the Fed independence that can also impact the rise of the dollar.
Wow. 20 Agenda 2025. That's great. This is really interesting. Really, really good.
But the market likes it. The market still interprets the task force coming in and the QE potential and the Fed rate cuts and the falling energy prices. All of that stuff is still getting priced into the concentration risk of AI. And now we have Micron earnings Wednesday after hours, and everyone's already long. So this is actually my expectation. We kind of went into Avgo and Sienna and a few others that were in the AI trade a few weeks ago. Literally June 1st marked a short-term top. We had some dispersion unwind. I think we're going to get that again because everyone is long Micron.
Yeah. And Micron's the big name for this week. Reports after the close on Wednesday. But back to you, Pax. Just a little bit more than a soggy open at this point now. Curious, what are the levels you're looking at here for S&Ps? How are you thinking about the equity market for this week? We threw a lot at the tape last week. Obviously, the week before we had the SpaceX IPO. Last week with expiry, we had the Fed meeting. Equities have kind of held together, but on the hopium trade of the Iran deal, kind of walk in today a little bit softer than I think maybe folks expected. The back and forth with the Iran stuff, but oil's up 1.6%. The dollar is a little bit bid. Bonds are selling off a touch. How are you thinking about the levels for S&Ps?
I've never seen a bid that I haven't wanted to hit in my life. And so I'm either going I'm going to wait until I think this is kind of a bearish open. So I'd want to be short against the opening print at 75.43 and change, whatever that is. But if the S&P can get under 75.08, I will sell them aggressively. It opens up. We're going to have a very, very busy summer. The third quarter is going to be really, really, really good trading. NASDAQ corresponding price is 30,263. If the NASDAQ gets under 30,263, then I'll be short. And I'll be short aggressively. I don't know if I'll be short NASDAQ, but I will be short S&P. I try not to trade NASDAQ anymore. But until then, traders, you guys can look to take a wiggle against the opening print and against the overnight high, which is what's the overnight high? 73.5. You can look to take a little bit of a short there. But in the meanwhile, wait for the setup tomorrow. And when we get it with RTH, if we turn around and start to rally above the opening range, then you can get long a little bit and look for those rotations. But for the most part, I'm a sell the rally guy at this point, and underneath 75.08, the next level is going to be 74.5. Underneath 74.5, then it's going to be a long way down. Well, 74 even, and then another 200 points until we get down to really 67.96, so 6,800.
Pax, when you talk technicals, just technical structure. Remember when you and I talked over the phone on Friday, and we talked about last week's midweek lows, right around the FOMC, right through the FOMC. The spike low actually resides at a 38% retracement of June 10th's low to the high from earlier last week. I guess it was on the 15th. So that spike low is basically the 38% retracement. So if we breach last week's lows, that's where you think about bulls and bears and bullish setups. Usually what constitutes some sort of bullish setup is a shallow retracement. So when you get something below a 38% retracement, which happens to be last week's lows, that's when bulls say, you know what, I don't want to be long anymore. So then you're really opening up some downside below there.
Yeah. So 100%. So if we take out 75, what was the low? 74.
74.60 something.
Yeah,
70.
74.72, I think.
That's
So
correct.
if we
That is
take
correct.
out one, we take out 74.72. I'll already be short from 75.08. I'll take some off the table there, and when we get under there, then I'm going to sell them, take more off at 75. Yeah, if we get under there, sell more, and then I'm looking for 74, like 74.06. But that's the trade plan. It's to be and to be flat in here. There's really nothing for me in this general area that we're trading. But man, we get under that level, then that'll be the trade. And if we can get below 74.72 last week's low, then like Sarah would tell us, then we've got all new capital flow underneath there. So I'll already be short, and I'll be taking profit to everybody that'll be selling them, and then take them lower. And same thing in the NASDAQ, by the way. It's the same setup.
And when you start talking like 6,700, people look at that and they're like, man, it is so far away. But if you look at the just like longer term, and I'm going to just zoom us out a bit.
You have to.
Yeah, this is a channel we've been respecting all the way from 2018. We get back below those lows from 7,200 or 72 and a quarter, wherever it was from 2 weeks ago. That's when you have like a false breakout. You have the technical structure. A lot of people call it a throwover. Some people call it a slingshot. I just call it a false breakout. And then you got everybody trapped at the highs. And that's when it really, you start to look at like, what's the rest of the summer going to shape up to look like? And that's where 6,700 doesn't look so far away.
Right. It really isn't.
Yeah.
It really isn't. That doesn't mean that we don't turn around, that we hold 75.08, and then we don't turn around and start to rally up to 79.65 or 8,000. Crazier. Well, I mean, just take a look at that. Look at that chart that we have up on the screen. I mean, look at that crazy rally that we've had off the lows. The 65.53 was the low 2 months ago, or
right,
however long that was. But I mean, that's just craziness. To think that we can sustain that bid. But then again, again, stranger things have happened. March 30th, that was the low we made on March 30th. Just look at that crazy shit.
But we also had March 30th, the end of quarter pension rebalancing, and it was very positive. And we had short covering that triggered as a result the beginning of April. Then we had the April 8th Trump headline for ceasefire, which had us gap above the 200-day, the mosh pit of moving averages, and go. Then we had CTA buying, vol control funds, suppressing volatility. We had the oil futures market highly manipulated with insider trading, right? So there was, and then we finally had retail join in. So we definitely had a rally for the ages plus AI, and we can still move higher. This is true. But not with a dollar that's rising. That is definitely a short-term headwind.
Right. What did you call the 200-day, the mosh pit of what?
No, it was every moving average. If you look on any daily chart, we gapped up on April 8th with that headline of ceasefire, right? And it went above the 200-day, but it was also the mosh pit of all moving averages. I don't care what you use, 55. It doesn't matter. They were all below as we jumped above and stuck that landing. So then, of course, we had a little dispersion unwind the first week of June, and now I think we're going to have a little bit of a summer storm. But ultimately, we have another reason why the market can go higher, not just the negative real rates that I talked about with a whoosh, effect. And that is definitely, I think, his goal. But also, you have a situation where you've got yield chasers, and they really are not looking at the oil crisis that could be in the future. It won't happen until it's here physically and they can feel it, right? So you also have a situation where you have slow hiking schedule, because right now, again, rate hikes are also very detrimental to duration trades. So you got 4% on the 10-year roughly. You can buy the S&P at 3.7% yield. That is a reflation trade that yield chasers will buy every day. So I know that's a kind of a more fixed income focus, but the point is, if they're not expecting an energy crisis until midterms, they're not expecting the rate hikes until we have an energy crisis, then they could absolutely build this thing up in a melt up. But first we need to go through a little bit more, I think, unwind end of month rebalancing.
Hey Craig, Treasury Secretary Bessent, he's got to shill out some 2s, 5s, and
7s. Yeah.
Yeah.
But what I was going to say is it's 250-year celebration, July 4th. You don't think it's going to be new high on the 4th of July? I mean, come on, let's get it up there. But one thing we do talk about all the time is the flows, and there's been a lot of talk in the Twitter sphere last couple of days about kind of record pension rebalancing for quarter end, given the outperformance of equities versus fixed income this month, and particularly this quarter, that we could have record equity for sale on June 30th or the early part of July. And so to your point, Samantha, kind of the opposite of what we saw at the end of March.
Yes, correct.
And so at that point, I so vividly remember Anthony mentioning on March 30th how we were kind of, NASDAQ was 3 standard deviations below the year-to-date VWAP, and how that, was kind of historic in his mind, and, what a great call, and, kind of getting along there. I think we're pretty elevated now, and we have all the flows kind of looking the other way, right? CTAs are long, retail is long, pensions, everybody's long, call buying, FOMO is in. And so, now that you have this window of potential weakness reopened, you have, cross asset traders and other folks who look at the dollar more closely and that implication on the economy and on asset prices, those who are looking at the rates market, particularly short-term rates markets, and moving, those yields moving higher, hikes being priced in. We had a massive curve flattener over the course of last week, which has unwound a lot of steepener trades, which people have had on all year. And so, we're in a period here where those flows are going to matter more. Right now, broadly, we're in positive gamma, but we know as we start to move lower, if we start to move lower, we could quickly cascade into more of a negative gamma regime into that quarter end dynamic with the pension rebalance. So. But a lot going on this week with those auctions. We also have those Micron numbers on Wednesday. We have what else do we have? We have the flash PMI on Tuesday, and then importantly, core PCE on Thursday. Even though we know, we broadly know, 75, 80% with 80% chance of the number, you still have to get a hot, reading there. And for a new Fed chair who wants to be more data dependent, if we have another hot PCE print, we're only going to get one more inflation print between, one more CPI print before the next meeting. If this PCE print comes in hot, it's going to be very difficult for folks to not think that the odds of a rate hike for the next meeting are going to move even higher. Right now, 35%, but I can see them very easily going above 50%. I mean, if he's going to hike, why not just hike now? Right. I mean, now is when, the pressure is there. Well, when more of the committee wants to do it, if you think that the economy is too hot and he want to bring inflation back to target, and you want to have credibility later with more members on the committee, and clearly, Warsh is coming in without necessarily a lot of friends on the committee and a lot of credibility. He needs to do a lot to eventually get people on his side. Moving sooner probably would make a bit more sense. So,
do you want the committee on your side, or do you want President Trump on your side?
Look, I think
do you want credibility? Do you want credibility, or do you want headlines?
Do you want to get the shit kicked out of you he's got the job already. So, it's going to be very difficult for him to be replaced. In order for him to move at least, 9 members of the committee, he's going to have to show them that he's on their side when, things are averse, such that when things move in the direction of cuts, they'll say, yeah, it's time. You're right. And so let's
see what happens with labor data too, because I can see absolutely a case for a normative cut in July. Not popular, but I actually had that earlier at the beginning of the year. So this is something where I think they could do a normative cut in July and then an accommodative one toward the end of the year, should we get some energy crisis brewing again, which is a real risk. So
you mean a hike? You mean a hike, not a cut?
Hike. Right? Did I say cut? Oh my God! Yeah. No, sorry. July hike and a normative and then accommodative one toward the end of the year because of inventory drawdowns. I mean, we're talking serious. SPR levels 1983, right? US is now going to be a forced buyer toward the fall. You got OECD reserves very much drawn down, etc. There's no lack of energy risk coming in to the future, but also the the fact that we've got Bank of Japan also has their July meeting, and they have a Fed problem. Bank of Japan has a Fed problem. They did their normative hike, this past June, but they have a bigger issue as it relates to energy costs.
Yeah.
So wouldn't be surprised if they kind of do a little bit of coordination there. But I wanted to show you the dollar, if that's my little view anyway of
Yep.
this chart. If I can show you real quick.
Yep.
Let me know.
Yeah, you're
I
good.
got it. Okay. So, here is this dollar on a weekly standpoint, and it's got just a gorgeous little scoop pattern. I know everyone is hyper focused on a very small time frame, but big picture, that's the dollar. And you were just talking about returns in tech land, right? Micron being bellwether for absolute sure. And it's got a 1,500 price target by, Stifel last week. And they're still swinging for the fences there with calls galore. And I can show you where they're absolutely all long in Micron. But right now, options market are also, this is Apollo, bracing for this tech shakeout. There is just a little bit too much. You know how I say outliers also revert with velocity? That was my theme for June 1st, that first week of June when we had a dispersion unwind. So I can see another case of that because we're just getting, the market right now is a little more fragile because of this concentration risk in growth stocks while the overall S&P volatility stays relatively calm. That's a chart from Apollo. This is one, and I forget, Bianco, he's been showing that, you strip out the AI contingency and you got flat year-to-date market.
Yes.
And then we have this AI ramp outsized returns that did have a little alley-oop into the first part of June before Trump came out again, right? We've got an MOU coming up. So the point is, right now it's very headline driven. But if I may, just real quick, when I said Micron is actually everyone is long, which is why it's not so exciting for me right now with Micron. You can kind of see that if I put premium paid on Micron, this is a tool that I actually have, and you can check it out, option-teller.io. You can see premium paid, massive bullish bets coming in, but also lots of puts sold. So for me, that's kind of as good as it gets when it comes to some of these earnings plays that are coming up into focus. And once you clear that event, then you typically have a market that can go into digestion. So that's baseline bet what I'm looking for.
I mean, Micron's up 260% from the March lows. I mean, if you're chasing it higher here, I mean, you're asking for problems. I mean,
big bulls. They're all long.
So. Yeah, I mean, yeah. Anyway, Wednesday should be interesting, and how it trades after Wednesday is going to be really interesting.
Yeah, for sure. Well, we're about a half hour in here, and thanks for everyone who's been joining us. Chat. If you have any questions, just post them in there. Definitely send some likes our way. Really appreciate it. But again, a soggy open. S&P's down 40 basis points, 75.40. Russell down 57 basis points. The Nasdaq 58 basis points. Gold a touch softer. The dollar a bit stronger. I think we kind of someone asked in chat about the gold move. We'll talk a little bit more about the gold move in a second, but I wanted to mention the oil price here, 77.61, up nearly 2% or 1.5%. So, and December crude also. So, Blake, your thoughts on crude here? Maybe to throw up the crude chart. Part of the hopium trade and getting yields down was the oil price, which, the peace trade, oil really had some negative price momentum in the early part of last week, even kind of ahead of the MOU. And then really, I don't know, did we wash it out? It's going to stabilize. It's starting to move back higher again. I mean, the Strait, as Tracy likes to say, the Strait's still closed. I think she's right, because it doesn't seem like things are really, moving so rapidly out of there. But what are you seeing here on the oil price?
Well, okay, so Tracy and you and myself, we had this conversation. It wasn't last Friday, it was the Friday before last, right? We're just waiting for a shakeout below $80. Cracked out those lows, get everybody short. Notice how we respected and we created a hammer off the 200 DMA. That was actually on Thursday. Friday, Thursday, we stabilized there. Friday, we created a hammer. And today, we're gapping up and we get much above $79. Then you're going to trap the entire market on the short side. And as we were saying a week and a half ago, let it clear out all the longs, let people get short, let people believe, Trump says that, gas prices are going to come down rapidly, crude oil is going to come down rapidly following the MOU. And, I still believe that there is going to be a supply issue. Tracy and I have had those conversations. I know you and Tracy have had extensive conversations about this. And I think, we get back above 79 to 80 bucks, we're going to be squeezing into next week. And that's not a good sign for anything, for risk or anything. So, it looks good. I mean, I'm still laser focused on this level right. Whoops. Let me move that red line right here. The previous breakdown point comes in at 79 bucks on the continuous contract. So we get above that, it's squeeze city, and I like it to the long side, frankly, as long as we're above the 200 DMA. That's something we've been talking about for the last couple of days.
Yeah. Pax, any key levels for you here in crude? Any
77.70 is a long, if you draw a horizontal line, if all you draw a horizontal line going back 20 years.
I'm doing it.
It is, you look at it, it's incredibly pivotal. So, from a trading standpoint, I want to be long crude, but from a trading standpoint, you can take a short there, and then you're looking for the 200 day down at 75.05 is the price, but 75 like 15, a little bit in front of it. And then if we get under the 200 day, then you're looking at last week's low. I think it was last week's low, like 73.60, 73 double.
There's that 77 level that you're talking about, how pivotal it has been for so many years. I mean, it is, you can
forever.
Forever.
Yeah. Well, old lows, old highs. Can you put Blake's chart up real quick?
Oh, it's up.
Oh, I'm sorry.
Yeah. It's up. It's up. So you can see exactly what Pax is talking about.
Yeah. So, I mean, that's a huge level. Once we get above there, then I want to be long. But right now it's just, from either a nothing trade or a small short. And then if we start taking that price out on the upside, it's awfully hard to really want to be short crude here, except for the president's sentiments. We're heading into the summer, and that's going to firm price up, or who knows what's going on in with Iran, and the Strait of Hormuz is, as Tracy likes to say, is still closed.
And the reserves, how low are reserves, Craig? I know you guys talk about it daily, right?
Right.
Yeah. Look, I mean, even the president himself mentioned kind of the idea that we're 4 weeks away, or from reserves being kind of at tank bottoms, and the functionality of the reserves being really in the trouble zone here. So look, I mean, this is the reason why he's so adamant that he doesn't want to continue this war. He is obviously hypersensitive to the oil price. He's done a reasonably good job of bringing the oil price back down over the course of the last several weeks. I mean, we're certainly materially lower than those spike highs from March, and he gladly tell you he thought it was going to be double that, the pricing, and so he's patting himself on the back a bit. But we're stabilizing here in levels that really are not great for the rest of the economy, right? We've talked about how the AI trade and the AI capex really, the oil price is really not such a big driver, but for the rest of the economy, it is. And so we've seen the weakened consumer, weakened small business, the housing market continues to be soft, and elevated energy prices are a part of that. And so given the polling data, given the midterms coming, the president's doing whatever he can to try to bring the oil price down further from here. We'll see. Samantha, how are you thinking about the oil price targets and setup here in the next, little bit, but then also more structurally?
Pax likes my one-liners, so I've got one for you. There are better things to trade. So oil to me has already had inventory basically released so that the real economy hasn't been hurt yet. Once that, and 400 million barrels, I think it was, is a lot. So that's the ballast that we needed, that also gave this amazing, robust trade to the AI data center build out and CAPEX and the rest, right? We're at peak buybacks, by the way, with those hyperscalers. So we've got some other things to worry about. But energy cost, I think, will come back, no question, later. And so right now we're just kind of in that la la land, or that sweet spot, but we also have massive headline intervention. It's really like we were talking about the yen intervention. When did they do it? They did it on a Friday night when Japan was sleeping. And if you're not, and if you're not in front of your computer, US, you're going to miss it too. So I think the headline risks, the futures manipulation, and the energy deficits that we're going to have to deal with in the fall will be very front and center. But right now, they're just better things to trade. And I think, you know, we've already talked about rising dollar. Currency is very important. It's kind of front and center right now for me. Headwinds of higher yields, not when you have oil falling from this supposed embargo release. So bonds right now are going a big sideways. Could they get bid? It hasn't been a safety trade, right? Dollar has. So I think we can still have some summer storms, but as it relates to oil, no. I like refiner margins. I like refiners as a swing continuation trade, Valaro and, you know, PBF and the like. I think refiners, even before hurricane season, are printing money. So there are some individual, you know, plays within the energy sector as stocks. And since I'm an options trader, I'm kind of more focused on that. So basically, I think there are other things to trade versus oil itself. Long story short.
Oh,
yeah, look, I mean, the story for it's all, you know, there's still a big correlation trade here. I mean, in oil, in order to get the rate cuts, in order to get what the president wants, oil really needs to fall in order to take more of that heat off of the inflation market. And so I'm just looking at December crude, you know, up at $74. I mean, you know, we're still, you know, back in February, we were low 60s, right? And so we're 20% above where we were in February before the war. And these prices are sticky. Obviously, they're off the highs, but the only way we're going to get rate cuts and real bond market strength and real fixed income strength is with oil moving materially lower. And it doesn't really appear like we're going to get a very easy resolution between Israel and Lebanon. It doesn't really seem like Iran is in any desire to remove their negotiating power by kind of dialing up and dialing down the velocity with which ships move in the Strait of Hormuz. So I think we're going to continue to just kind of be in a, you know, sticky oil market that really doesn't show enough momentum to the downside to allow you know, the Fed to, or at least the president to get what he wants, which is lower interest rates. So a very tough setup there for him.
Doesn't it feel like Israel is like that? Imagine like two boxers in a ring, and then the referee comes in and is like, you know, the round is over, and he's trying to separate the fighters, and Israel's like that fighter that just keeps like throwing punches even though the round is over. Doesn't it feel that way?
Yeah. Look, there's you know, there's some existential issues that Israel is dealing with here, and they would like to see the job finished. And there's obviously, you know, folks in America and folks on the, you know, in the administration who would like to have seen the job finished. But the president has very adamantly said that he did not want to become Herbert Hoover and put us through a depression in the economy, in the oil market, in the stock market by continuing this war. And so he wants to move on, but you know, Israel's not looking to really move on. So this is a problem that we're dealing with here.
That's an interesting point too, because if he doesn't want to be another Hoover, if he is another Hoover, he will also be the president that is responsible for the dollar losing reserve currency status in that case. And then what?
Yeah.
And he doesn't want to be that way.
Every time the dollar drops strongly, he raises tariffs, whether he has the constitutional power to do so or not. So he loves the falling dollar because it also makes objects appear taller, right? So the equity market loves it. Your car, your house, things basically that wealth holders own. That's why he says he loves inflation, but wage earners not so much. So we definitely have productivity promises on AI, and Warsh is banking on it too. They haven't come to fruition because it's just too dang early. In the meantime, this is still an inflationary backdrop. If oil was to drop precipitously, either from a deflation scare or substitutes, right? Real legitimate substitutes, EV cars and the rest, which they have done over in China and, you know, in Europe and South America now too, then we'd have an economic stimulus. So he talks about falling oil, but really what's the replacement here stateside? We've got some issues with that. In the meantime, we have Iran war is still not priced in. And there's no part of me that actually believes that Trump is done. I think this is definitely just a short-term ruse before the midterm, and then the day after,
Right.
be more aggression.
QE. That's more QE. That's more hidden QE. Some more. Sorry, you're 100% right. He's gonna save the. He's gonna try to save the midterms, and then who knows what.
Yeah.
And what you're pointing out, Samantha, as far as like the basing pattern of the dollar index, I mean, a lot of us in currency land are looking at this descending channel. That puts the dollar index at 107.
I got 105.
Yeah, I mean, 105 is here. You get up to 107, you overshoot, which currency markets tend to overshoot quite a bit.
They do. Mm-hmm.
And so us getting up to 107 is the euro trading around 108. I mean, and that puts a lot of pressure on everything.
Yes, it does.
Class.
Well, that is non-bullish.
No,
that's non-bullish. We're not there yet, but
Right.
It's something to be on the lookout for. What are the macro triggers that will interrupt the bullish flows that are clearly in the stock market? Private credit is kind of, watching a little nervously, and the bond market is flat as a pancake for the most part, waiting to see what Warsh is going to do. We've already talked about what I think is, the negative real interest rates, but also bank deregulation. You've seen banks run up into the Warsh FOMC, presentation there, right? He didn't talk about bank deregulation, but that is another way to stimulate the stock market. The trillions of reserves and such, and maybe a little bit more, loans that are out that are stimulative. So long story short, I think we'll see lots of ballast to the negative effect of dispersion unwind or yen weakness, whatever happens with energy in the future and rising dollar. I think we can still have some ballast that they'll try and come in, or the levers that they'll try and pull around bank deregulation and negative real interest rates to kind of juice the market some more.
Wanted to shift to gold because I think gold is something that everyone owns, or at least here, everyone owns some, and yet the price action has been horrible. And after last week, with the hawkish direction of the Fed, real rates actually moving higher, particularly in the front end of it, and oil got smacked. And weak again in the overnight session with a dollar bid. Pax, what are you were talking before the show about some levels in gold and kind of getting more negative here? But how are you thinking about the setup for gold here?
Well, from a trading standpoint, I really don't. I don't want to have anything on in here from a just from a short-term perspective. I want to see how gold is going to act with this dollar rally, and I want to see how gold is going to act with crude sort of finding its equilibrium. I think the more that crude hangs in at these prices, the more bearish that is long-term for gold, and obviously the more the dollar holds and rallies, the more bearish it is for gold. So I don't want to trade it. I can make a case for getting long against 4,100, but with a very tight stop and getting out of there quickly and reversing and getting short. If gold takes out 4,100, if gold takes out this old low, which also happened to be the 200-day moving average, and again, if you take a look at if you take a look at a longer term chart, and you just look at the 200-day moving average. Every time we traded down to it, gold bounced. Going back to 2023, every time we trade to it, it bounces, including back in May, in early May or mid May, when we came down to the 200 and we bounced again from it. Now it's 4,100. We took it out. We're below it for the first time since. Well, we're a little bit above it, but for the first time since 2023, we traded actively below the 200-day moving average. So I think that once we get below that mosh pit of moving averages, I want to get short underneath there. I don't want to trade it here. Underneath 4,100, I think gold is in big trouble, big trouble. Down to 30. Between 3,350 and 3,500, the technical level will be coming more around 3,500, but there could be some downswing down to like 3,350.
See, you know, we talked about this a couple of weeks ago. Remember when it was traded, it just broke the 200 DMA, and we're like, man, this thing looks bearish. And back then, and I know 2 weeks is a long time.
44.24 is a 200 day. I'm sorry. The old 200 day was 4,800. I'm sorry. But
right. No, you're correct. But remember, we were like, if it trades below 4,000, it's going to trigger a bunch of stops. I mean, it just, you know, everybody's got their orders perched around the 4,000 big figure level. 3,900 is a spike low if you go back to October of last year. So that's where things get really dicey, I would say, you know, for anybody that's long. So for you to say, for it to get below 4,000, then it takes out 3,900, excuse me, 4,000, 3,900. Yeah. I mean, how could we not trade back to 3,500 pretty quick?
Well, yeah.
It's like an elevator.
Well,
right?
I mean, this is the first time that we've traded since September of 23. It's the first time that we've traded significantly below the 200 day. 44.20. When we took it out last week, we traded straight down to that old low of 4,100. You know, we took it out, made a new low, got back above it. All right, back up to 43.25. If we make it back to 43.25, you got to get short.
Yes.
That's it. If we make it back to 43.25, that's your line in the sand. If we get above 43.25, back to the 200-day moving average. But you know, as Samantha was saying earlier, with the strength in the dollar, and you and I have talked about it many times on the show and offline. It's with the strength in the dollar, it's very difficult to want to be long gold.
Can I show you my chart, your 3,500, and also some option flow in that GLD? Is it possible?
Yeah, let's do it.
Okay. Because we talked about this actually on the show. So I was bullish dollar. USD JPY was going to break that 161, and that's actually why I'm looking for the summer storm, is because of that action. But in gold, right, you've got what you just said, right? This huge trend line. I've got it on basically down here, which is a gap up. And this is an absolute magnet around that 3,500. But what I find really also interesting is the fact that you could see how we had a short-term bounce. We were talking about that prior to the FOMC meeting and the dollar moving higher. Now, if I go into and look at to see what's going on with the largest ETF, can I show you a GLD ETF?
Absolutely.
Yeah. Okay, so here's GLD. This is all options. This is customer matching. What comes in? This is a 7-month look back, okay? And I just sorted by premium. The most premium is over 35 million. Very, very important because it's a lot of money. Also 18 million, another 15 million. And you can see puts are still getting bought. Now, when was this trade, put on? June 11th, June 15th, June 11th. For July, September. So there's some big money that is still coming in. This is just recently, literally June 11th. And they're very bearish gold in the short term. So until this turns around and becomes like a micron, right, where everyone's long, you kind of go with the flow.
Yeah, earlier in the year, or toward the end of last year, when we had the moves in silver and palladium and platinum, and gold was kind of getting dragged up into that, and we had that all the money was flowing into precious metals, and that really led to the blow off. And more recently, it's just as the money is flowing elsewhere, it's just the precious metal story is just getting left behind. And the narrative is challenged, at least for gold, because central banks are raising rates, right? I mean, whether it's the ECB is raised, the BOJ is raised, now 35% chance that the Fed's going to raise in July. So gold likes liquidity. Gold likes rate cuts. And so we're just not getting that dynamic in play. The global economy is holding on much stronger, I think, than folks believed was possible amidst the war and amidst the slowdown at the lower end of the K because of the AI story. So it makes it more difficult to find this narrative now for gold, which had really been in place with the deficit spending from the U.S. and Japan and all these other countries, the increase in deficit spending. Well, right now it's being kind of offset by the tightening cycle, so making it a bit more challenging. But
that plus the Strait of Hormuz became the focal point, right? So gold was a shiny thing, literally. Silver before that, 16%. Drawdown in 2 days. Silver was 39%, shaking out all of the short duration, right? The last in, first out bulls. But then what took over was oil. So even though we had that little reflexive bounce, this is when the Iran bombs, started the Trump-Netanyahu, war, 28th of February, Oil took center stage. And so you also have governments that were selling their gold. Turkey, Russia, they have disruption, settlement of trade in gold, especially when energy crisis or infrastructure is getting bombed, is a thing. It's a negative headwind.
Well,
So
yeah, I'm sorry, I didn't want to interrupt. Well,
go
I
ahead.
did want to interrupt, but I want to make a point to your point is that governments can't power their economies on gold or silver, which they've been acquiring for the last several years. So they have to sell that to buy crude, and which they've been doing. Yep.
And you can see the high, the second high in gold, and then that was all oil, front and center. Pay attention to oil because now it matters more. So that was it. It's just this is still a bearish trade from what I can also see in option flow. Long story short.
Yeah, and a lot of, and I know silver has kind of got the cold shoulder recently, but a lot of people try to figure out how is it that silver can make it back to the mid 50s. The big, that was the all-time high breakout was around the $55 level, $55 level. We can see it. Technically, we can reach it. And those levels are now doable. I mean, we're trading at what, $65 right now, spot?
Yep.
So, I mean, we're 10, 12% away from seeing the big breakout point, which, if you're a precious metal hodler, which you should be, like I keep it in my which probably I'm sure a lot of you guys do, you keep it in your safe. I mean, this is the time that you got to be loading up. You got to be looking at these levels as very attractive. Whether you're buying silver, whether you're buying gold, this here's this $55 level in silver. We could very easily trade down there. And gold, as you guys were talking about earlier, around 3,500. I mean, why can't we see it? And why can't we be acquiring, at this big breakout point here in gold? And that's the time you want to actually be walking over to your I like my physical broker literally is a mile away. And when gold and silver are in demand, you can't get your hands on physical. This is the time
Are you
when
talking
you
about 3,500 level?
Yeah.
Yeah, Gundlach did an interview 1 week ago, and he said, "I will buy with both hands at 3,500."
No doubt. Me too.
And you got to be at 3,600.
And the corresponding price in silver is got to be down near between 55, like Blake said, 55 to the Hunt Brother high. Yeah. Well, even as low as the Hunt Brother high. Wouldn't that be interesting if we can see that $50, $51, a little rundown, some stops being run down to $51, and I'll be running off to the broker too.
Right. I mean, and that's the time when nobody wants it. That's the time that you guys got to be looking to be acquiring it and putting in your
how
bids.
will miners react? Because ultimately, if we do have this, this is one of the reasons why we had such an outperformance in gold and silver miners the past 2 years, because price of energy was falling, and that's 40% of their operating margin. So it's a big tailwind for margin for metal mining margins. So basically now we need to get this under control so that they can get back in play too. It's not just the underlying, but it's actually energy costs are a huge reason for the season for these established miners. And by the way, this is another kind of great play once we get settled, probably more like Q3, Q4. But the point is, they will outperform in 2027, my firm opinion. Inflationary assets are the boomer stocks are the new inflationary assets, but miners in particular with their heavy production and lots of other, like the Ciscos and the Intels. One of the reasons I was bullish wasn't because of the AI per se. It was because they already had the people, the financing, the processes, in place. It's already incredibly hard to replace those assets. Miners fall into that camp, especially with the administration's view toward China.
Yeah, I just pulled up some charts, on GDX and GDXJ. You guys can see they're clearly coming into some pretty important levels. So, as Samantha's talking about.
Yeah. No,
but the bearish flow is still very, very clear. Just very, very clear right now. They're still under distribution. So not consolidation, distribution. Big prints are still coming in, have not cleared, have not covered. We're talking very large, and that's what I look for is basically where the footprints are for where capital is deployed, bullish or bearish. And right now that precious metal sector is still out of play.
Yeah. Last look here. It's coming up on the top of the hour, and we have the crypto closeout coming up at 7 o'clock with Follis. And I'm going to hang around too to chat with him for a few minutes before we get to the guest later on. But S&Ps are a little bit softer, down 15 handles, 75, 42 last. The NASDAQ down at 83, 84, 30, 567. Oil up to 77.50. Gold flattish, I guess, right? Oil up, I mentioned that. Bonds are a little bit softer. We'll end on the Bitcoin, as Jim likes to call it. It also likes liquidity, and it's not getting it. And it's not been performing. But Blake,
do you mind if I start?
How does a Bitcoin chart look to you?
It's a bear flag and a bear flag and a bear flag, buddy. So,
Yep.
I mean, I don't know how else to explain it other than, and I know it's scary, especially if you guys are like crypto hodlers, which remember Wall Street, now that it's been, it's been woven into the fabric of Wall Street. There are no hodlers, they're risk managers. And that's the thing that anybody that owns crypto, you just got to keep that in mind. It is a great trading vehicle, probably one of my favorite trading vehicles, but we have a bear flag, which the first bear flag target comes in at 52,000. That you guys, if you've listened to me for the last several months here, know that that's ultimately the problem. Is that what's happened over the last 4 months is this weekly bear flag pattern has developed that actually points to 20,000. I know that's a scary number, but I mean, it's not, it's someplace that we were at just a couple of years back. So it's not like, like we're going to uncharted territory. But the 4-hour chart, which is a little bit more scary, well, in intraday, is we have a bear flag that points, to a lot lower levels as well. So it's a bear flag and a bear flag and a bear flag. So I don't have anything else to say about Bitcoin other than it's not very constructive if you're bullish right now.
Nope.
Samantha, final word to you on the Bitcoin here, right? What's your outlook?
Pax is going to love this. Better things to trade.
She's right.
Yeah,
absolutely. I don't want to look at it in any way, shape, or form going below 51 or 49. I couldn't agree more. And I see exactly what Blake is saying. I mean, I don't want to touch it.
Yeah. I mean, another asset class without a narrative, right? And so in a market that is trading narratives consistently and where money is chasing narratives, we had Ben Hunt on the morning show several weeks ago, and he talks about how important narratives have become, and you're really seeing that, right? We're seeing that in the options activity, we're seeing it in the call buying FOMO, consistently in these AI names. And, there are times episodically where that money shifts into thematic things, whether it's oil at the onset of war or silver at the beginning of the year or, Bitcoin at times. But once the narrative is gone, all the money, seems to leave. And when you don't have the support of the passive flows that the equity market has, it just, the asset classes, the crypto asset class, it kind of falls by the wayside. So it's become more challenging for sure for crypto traders.
I was just going to mention, you guys got to be on the lookout though for like, a lot of these names, and I've had some conversations with some folks recently about, just looking at some more obscure names that are, into whether you're talking about hyperscalers and or what do you call that?
Hyperliquid.
Hyperliquid. Thank you. I said hyperscaler. I don't know why I said that. But hyperliquid and some of those names, there are some really unique names that I think are going to provide some great long opportunities soon. And I'm going to, on this show or on one of our shows here on NinjaTrader Live, I'm going to start bringing up some different names of some that have got my attention.
I want to just thank you all for joining me on the Sunday Open. Samantha, it was
Great
a pleasure
show.
having you with us, and Blake as well, and Pax. Go enjoy dinner.
Join Club to trade with Samantha. Scan this QR code or click the link in the description.